Hi, this is Dave Clayman. It is 12:01. We are going to get started in just a couple more minutes. We're waiting on 4 or 5 more attendees, so we'll give them 2 or 3 more minutes, and then we'll get rolling. Thanks for your patience.
Dave? Dave?
I'm here, and so is everyone else.
Okay.
All right. Well, it looks like the majority of attendees have made it, so hopefully some others will continue to join us. But I'm Dave Clayman. Thanks for joining us for this month's webinar, Make the Most of Your Investment Strategies. So I am Dave Clayman. Some of you may have met me out talking to you at different company meetings, and I'm the co-founder and CEO of 12 Points. I'm joined here by Manny. Manny.
Hello, everyone.
What about yourself?
Yeah, I'm one of the co-founders of 12 Points along with Dave. For those that I have met, it's a pleasure speaking with you again. And those that I have not met yet, I look forward to hopefully meeting you in the future. We're here to be your trusted advisors on your 401k and retirement plans. And this is one of the things that we love to do the most is working with plan participants and getting them squared away and understanding the nuances around their 401k and how it works for them. So the first thing that we're going to talk about is, being a key driver of financial security is savings rates. So a lot of people don't invest into their 401ks right away. We're seeing right now a lot of, early, new grads and entry-level position employees coming into the picture and saying, I can't really put away for my retirement because, I got student loans, or I'm living with my girlfriend, or I'm getting engaged, or I'm looking to buy a new home. And obviously life is always going to throw these challenges at you, but you really can't make up for time. And that's the number one message that we present to participants in our 401k plans is being able to put down anything is better than nothing. Even sometimes starting with just $20 per pay period and working your way up, you really cannot make up for compounding. And always invest enough to receive a full company match. What does that mean? So a lot of places will work with what's called the safe harbor plan. So, if you put 3%, you get 3%. So just even being able to realize, if I can put 3% of my salary away into my 401k, I'm going to get another 3% from the company. So it's just really important to know whether or not your company has a match. And if so, just get there to get the match, because if not, it really is like leaving money on the table. But we usually aim to start around 10% of the salary. We think that's a really good starting point. And then eventually when you're salary increases as you move up the ranks in your company, will get you into, your maximum contribution. So this slide is here to show you the difference about compounding. So what does that mean is that over time, your money actually works for you, and that's the real reason why starting today makes a big difference. So as you can see by the table, if you started today and after a year of investing, and if you're doing $500 a month and earning about 7% annually, if you start today, after a year, you have about $6,196 in your account. Obviously, if you don't and wait a year, it's going to be zero. But if you go down the table, you can really see the big difference it makes by starting today, investing that money and letting it compound for you, that after year 5, that's a little over an $8,000 difference. And if you look at year 30, that's a really big difference of how much money could be in your account and, providing a more secure financial picture for yourself and your family down the road. And time, there really is no substitute for time. It's the most important part of retirement planning.
And one of the things that young people often think about too is, retirement is so far away. So we like to talk in terms of flexibility. It just gives you options. If you start now at a younger age and later on you have a family and you can't put as much away, well, you've gotten that nest egg growing for you. So you're able to give yourself the flexibility to lighten up your contributions later in life potentially.
That's a really good point, Dave. Yep, absolutely. And it's where you save, right? So benefits of tax-deferred savings and 401k plans, you're paying yourself instead of giving money directly to the government. I mean, right now, anything that you do is going to be tax-deducted, tax-deferred. So it just makes sense to lower your tax bracket now, and by investing in your own 401k, and then when you actually need the money, you're going to be a lot older. Your salary is going to drop. So you're actually going to be in a much lower tax bracket than you are going to be in your major earning years. So you're almost going to be able to recoup more of that money by saving it down the road and waiting to be in a lower tax bracket than using it now and not deferring into a 401k or another retirement plan vehicle. And there is no tax impact until you withdrawn out of retirement. So all this stuff is getting deferred till way down the line, allowing you to be in a lower tax bracket. And money compounds until it's withdrawn. So the amount of time you can leave it in that account, whether it's 25, 30 years, you're just allowing that money to work for you. It's not going to be like it's in a, right now, if you were in a savings account or a checking account, you're earning 0.01%. I understand that it's not really growing for you, but if you are in a retirement plan vehicle, and as the previous slide showed, if you can earn 7% on an annual basis, it really makes a big difference, and compounding is what gets you there. And, to allude to what Dave said, it should not be put off. It allows you the flexibility to, operate down the road if your financial picture gets tighter without saying, oh, crap, I'm not, putting money to my retirement or my future years. And one of the things that's going on right now, and I don't know if anyone, follows anti-aging or, behavioral finance and things of these natures, but where our life expectancies are increasing, and due to technology, biotech, and all these new medications that are coming out, life expectancy is even going to increase even further. They're coming out with studies that are saying that people are going to live a lot longer than most people expect. So we're going to need more money in retirement, and as healthcare costs increase, and they don't look to be slowing down anymore, it's just going to get more expensive to be alive down the road. So it really is important to be able to put away now versus in the future, and then at the same time give yourself that flexibility should any financial obstacles come down the road. And this is just a table of right now of where life expectancy is. To reiterate on what we were just talking about, we're living a lot longer. As the table continues to go down, we have a really good chance of hitting those high 80s and 90s, and if not triple digit numbers. There's going to be a lot of people in our generation that are going to have the privilege of seeing that due to technology. And I think being able to plan for that now is going to make all the difference in the world. No one wants to be, 85 years old, 90 years old and saying, oh, geez, I didn't really expect to live this long. So what am I going to do? Am I going to go ask my grandchildren for money, my children for money? It's stuff that we need to start planning for now, and having the time to do so and the flexibility to do so, I truly believe is going to make a huge difference for a lot of people. And it's not rocket science, it's compounding interest. And as Albert tells us over there, it's the eighth wonder of the world. And, it's one of those things that you just have to, you don't realize it until you actually take a look at your account and you realize month over month how much it's actually increased, especially in, bull markets that we've seen over the last 9 years. If you were compounding 9 years ago, you're sitting really pretty right now in terms of your retirement account. And it's not just interest on your initial investment, but it's also accumulated interest over previous periods. So interest is interest, and interest on interest. So compounding is the key takeaway from the presentation today, at least on my end, is that you can't make up for it, and time makes all the difference. So the sooner you can start, the sooner you can let your money start working for you, the better you're off you'll be.
And to Manny's point, that brings us kind of to 2018, and where are we? So investing in 2018, to Manny's point, we've been on a bull run for the last 9 years. So what do we do now as we start to see the markets get a little turbulent like they were yesterday? So first of all, you have all this financial jargon thrown around. So our industry does a great job of needing to feel intelligent and using every possible word to make themselves sound smart. So you hear active versus passive, mutual funds versus exchange traded funds. And then you got alphabet soup at the bottom. So what is this? So active versus passive. So an active management fund, which is going to have a little bit higher expense ratio or fee charge to you, is going to be a fund where a manager is actively choosing to pick what they think are the best investments to be in. So for example, if you're in a large cap United States fund, and the index is the S&P 500 that you're comparing to, the manager is going to pick the 450 or 490 best investments in that index in their opinion, and they're going to actively manage them. If you have a passive fund like the Vanguard S&P 500 index, that fund is going to just buy all 500 stocks in the exact proportion that the index owns them, and you're going to get that same ride as the market. Now, obviously, that's the hot debate these days is, gee, should I be active, should I be passive? Well, and passive's outperformed for a number of years. Well, there's an old saying that a rising tide lifts all boats. So if a market is going up, all stocks tend to go up. However, what we're seeing over the last year is that market is getting narrower and narrower. The median stock right now is actually down for the last 12 months. However, many of the indices are near their highs, and that's largely because a few stocks are carrying them. So is now the time to switch from active to passive? Maybe, maybe not. And then the other thing you want to be thinking about is what areas. So the US, very well developed, lots of news, lots of information, pretty easy for investors to get an idea of what's going on, and maybe passive makes sense. But when you start thinking about markets like emerging markets or sub-Saharan Africa or Asia, some places, you probably want a manager who's going to actually go there and understand what's going on, and are they actually making the widgets they say they are? Many countries have been known for inflating the facts, let's just say, when it comes to some of their companies. So it's a good idea to have a manager there maybe who's active. What's a mutual fund versus an exchange traded fund? So a mutual fund is simply a collection of investments. So let's say you want to invest in the US again. Let's take the large cap area. So instead of going and buying 5 shares of Microsoft and 4 shares of Intel and 3 shares of Honeywell, and you're going to buy a mutual fund where you and everybody else who owns that fund are going to pool their money together. The manager is going to say, okay, I have this amount of assets. I have $1 million, and I want to buy all these different companies. They're going to buy a piece of every company, and then they're going to divide up and say, oh, of that $1 million, 20,000 of that, it belongs to Joe. So 1/50th of everything is going to come to you. So if the fund owns 40 shares of Microsoft, well, now maybe you own 0.8 shares, or, they own 2 shares of Google. Well, now you're going to own, 0.04 shares of Google. So it gives you the ability to buy multiple things and really diversify your portfolio. What is an exchange traded fund? Very similar. The only difference is a mutual fund trades once a day. At the end of the day, you get your pricing. They divide up all the assets by the number of shares, and boom, that's your value. An exchange traded fund actually trades throughout the day and gives you the opportunity to buy and sell during the day. So then we get into alphabet soup. So you've got ETFs. Those are the exchange-traded funds I just talked about. You've got CEFs. A CEF is a closed-end fund. So those mutual funds I spoke about, technically they're called open-ended mutual funds, meaning they trade just that once a day. A closed-end fund actually trades throughout the day like an exchange-traded fund, but it can actually deviate from its underlying value. So instead of saying, oh, there's $1 million worth of assets, we have 20,000 shares, every share is $50, the closed-end fund's going to say, well, yeah, we might be worth $50, but right now the market's trading at $48.50. Oh, look, there's a discount of about 3% there, or $1.50. So you can actually buy assets at a discount to their underlying value. Can be a good tool. Not an option for your retirement plans generally, but a good option if you have a taxable investing account. FANG. Now here's one of the populars. So everyone talks about the FANG stocks. So when the market leadership has been getting narrower, the technology stocks have been very hot, and largely it's those FANG stocks. So Tesla, Facebook, Amazon, Apple, Netflix, and Google. That's what makes up a FANG. These are the hottest stocks out there. I think because the market has gone away from what we've looked at for years called growth at a reasonable price, and I'm saying that's now growth at any price. People are so desperate to find companies that are growing because the economy's not growing at the potential it used to, that they're willing to pay regardless of multiples. So what does that mean? It used to be that the average company traded about 15 times their earnings. So if they earned $4 per share, the stock would trade around $60. Now, you know, Amazon trades at a 270 times earnings. Tesla doesn't make money yet. Google trades at about 40 times earnings. Netflix at 400 and something times earnings. So they're all over the place. So valuations have gotten a little bit crazy. So things to think about, that they are higher risk. Yes, they've been higher reward, but they are higher risk than average. So things to be thinking about. Your IRA. So we talked earlier, Manny talked heavily about investing in your retirement plans, your 401ks. An IRA is an individual retirement account as opposed to your retirement plan that's company sponsored. It's an additional place to save. A lot of people don't realize they can save in an IRA even if they are covered by a retirement plan. That additional money growing tax deferred and compounding, like Manny talked about, can be a lot more valuable to you than investing in a taxable account, because you're not paying taxes on your interest and dividends and capital gains every year. So that's something to think about. Roth IRAs. So Roth is as opposed to an IRA, which traditionally is pre-tax money, a Roth IRA is post-tax money. So you've already paid taxes on it, but when you go to take it out in retirement, you won't have to pay taxes at that time. The current tax bill that was enacted, which lowered tax rates for this year, potentially provides a more attractive opportunity for a Roth IRA. So something to think about. So a lot of different terms, things to think about, things that we're here to help. So if you're a current client on the private wealth side, or if you're in one of our 401k plans, reach out to us and we can help define some of these things for you as well. You know, it's an important time right now. As we talked about, the market's had a run for 9 straight years. And, you know, all of a sudden Warren Buffett's become a passive investing guy. It's very funny. So Warren Buffett's one of the great investors in our time, but he used to say he only had 2 rules in investing. Number 1 is never lose money, and number 2 is don't forget rule number 1. So what does that mean now? Maybe it's not go 100% into the S&P 500 index fund, which I know a lot of people tend to do because they think they have a long time to invest. Well, the market's more expensive than it's ever been, as we talked about. So how do you take advantage of your opportunities? Well, it's looking at diversifying. And what does that look like? So investors right now, they probably have some unreasonable return expectations. So this is a chart of a survey that was done by Schrader's Global Investors. 21% of investors surveyed are looking for greater than 20% returns over the next 5 years. 30% are looking for returns between 10 and 19%. That means 51% of people surveyed expect greater than 10% annual returns. Over the last decade, the average has been 8% returns. So people think it's actually going to get better from here even though we're at higher multiples, more expensive market than we've ever been. I would say that's pretty unlikely. So, you know, professional investors are looking for U.S. stock returns to be somewhere around 5%, and a 60% stock, 40% bond portfolio to be somewhere around 4%. So maybe people are just getting a little bit ahead of themselves on what those expectations are, and again, might want to temper some of those investments in that index fund or the passive fund. This is a good look at euphoric breakouts from directional trends. So if you look at those blue boxes, those are times when we've gotten above trend lines or below trend lines, and you can see how big those moves, you know, that tends to be a change in trend. When in the first blue box, when we broke over the line there back in 2007, 2008, suddenly reversed and fell. When we broke below it there in 2009, suddenly we reversed and got back inside the line. So those tend to be changes. You can see late in 2017, we broke way above the line, and at a time when fundamentally things were getting overvalued, as you can see on the right-hand side, there all those different things that were overvalued. So market is showing signs of aging, of maybe having had its euphoric blow-off stage back in December and January. So again, maybe time for some caution and some diversification. This year's been more volatile. So if you look at the top left-hand side of the screen there, the volatility index, you can see over 20 years that averages that bright, or that burgundy line there, averages right about 20. You can see how far below through 2017 we were, dipping down into single digits on that green chart. We spiked back above for sure in early February, but now we've kind of settled back along that line. Everyone forgot that markets do go up and down. So on the top right there, normal can feel scary. It can, but flat is not normal. That scares me more, because it says that something bigger is going to change, that people are getting a false sense of security. So while I don't like the downs certainly as much as the ups, it's much better to be in a good situation where we can be, you know, be finding opportunities when markets do go down at decent prices. So there you can see at the bottom the number of days with plus or minus 2% moves in the market. From November of 2016 to February of 2018, we had 0 of them. That is truly unbelievable. In the 4 days at the end of March, all 4 were that way. And for 2018, by the end of March, we'd already had 7. We now can up that to 9. So that's volatility has returned, but volatility can present opportunity for patience. Here's a little look at the drivers of 2017 global stock performance. So the blue line there is earnings going up. The orange lines are the valuation of the markets going up. And then the gray line, that's the third component of your growth, and that's dividends. So what you can see is that in the US, only about half of the growth came from earnings, and a big chunk came from an increase in valuations. Whereas in Europe, the total return was actually less than the earnings went up. Same with Japan. And in emerging markets, it was about 2/3 of the growth. So we like all of those markets for being more attractive and growing faster than we do like the US. So something to think about, that international may offer greater opportunity here than domestic or US markets. What else do we see? We do see interest rates starting to creep up here. So a lot of people believe that when stocks go down, bonds go up, or when stocks go up, bonds go down. So they think that they're protecting themselves by having a diversified portfolio that's, say, 60% stocks, 40% bonds. Maybe they're going to be correlated. Maybe they're going to move in the same direction going forward. If the economy were to get stronger, it would make sense that interest rates would go up and stocks would go up. If the economy were to weaken, maybe they'll go down together. So those are things to think about. Where are your other opportunities? So if you look inside your retirement plans, generally we have added options that don't require stocks to go up or bonds to go up necessarily. There's some absolute return indexes or opportunities to invest. So certainly, again, you can reach out to us and ask us about those based on your individual plan. And then, why do we worry a little bit about this market? Well, we worry about things when they become illogical. So what has become illogical? Well, here's a couple of charts. So this is a chart of the orange line there at the bottom is the yield on a 2-year note in the United States from 2015 to 2017. And the blue line is the yield on a Greek 2-year note. So as of 2015, if the Greeks wanted to borrow money for 2 years, it cost them 33.91%. As of the end of 2017, it was actually 1.71%. Things didn't get that much better. The market just knew that the European Union was buying the bonds, and that meant there was someone else to buy from them. So people bought them knowing there was another buyer to take it from them at a higher price or a better profit. If you look at the orange line, the US yes rates have gone up here, but look at that. Look at how just 3 years ago, the Greeks were deemed 33% less worthy or needed to pay 33% more to borrow money than we did, and now they actually have to pay less. That does not make a lot of sense. So things to think about. And then also, on the right-hand side, you've got a chart of junk bond yields in Europe. So a junk bond is someone with lousy credit. So imagine that in 2012, a country with bad credit had to pay over 11% in order to borrow money. And now they can borrow money at 2.3%. Have you tried to take a loan lately? Can you get a loan even with good credit at 2.3%? Of course not. But this is where the market is not being logical. And when logic starts to retreat, we see problems. Just a couple of weeks ago, we saw Italian bonds start to become an issue and the market sold off. So the creditworthiness of Italy was being questioned, and that can affect the US market. So be conscious that we are at an inflection point likely in markets and valuations. And sometimes you're fighting for the return of your capital. Sometimes you're fighting for return on your capital. Sometimes you're fighting for the return of your capital. So be aware that it's not always stretching for returns and big returns. And there will be times for that. But I think 2018 likely isn't one of them. This is a time to be more conservative, to be a little bit steady, and to look for those mediocre returns, I guess I'll say, those absolute returns, and kind of that, 4 or 5% type years. This doesn't feel like a 10 or 20% type year. And then again, this is, when markets get hot like they did back in January, every investor wants to jump on the rocket ship of the high-risk portfolio. We're here to help you understand that a diversified portfolio, this is why you have it. Let's take that cab ride. So we're here to be a resource to you, as Manny mentioned earlier. I hope you'll take advantage of that. We can try to get a little bit deeper into where the advantages are or the opportunities are in this market, as we titled the webinar. And that's what we're here for. So as I mentioned, this is how you get in contact with us. Dave at 12pointswealth.com, there's my phone number. Manny at 12pointswealth.com, there's his phone number. And we're here to help when and if you have questions. I want to be mindful of your time. And we had promised that we would keep this to 12:30. So we are there. I don't see any unanswered questions at this moment. So I think with that, Manny, unless you'd like to add some closing thoughts.
No, thank you for everyone who took the time to, listen to our presentation today. We hope you found it valuable, and we really are here to help you guys and answer any question. And there is no such thing as a stupid question. So even if you think that we might find it stupid or you think it's irrelevant, just go ahead and ask it, because it could make a difference, and we're happy to answer. One of our favorite things about this business is being able to not just work with corporations, but the participants and employees of these businesses that make their products and make the business work. So thank you for taking the time, and we hope that you reach out with any questions that you have.
Great. Thanks, everyone. Hope to hear from you again next month. Take care.